We'll go ahead and get kicked off here. I know we've got a lot to dive into. We want to make sure we've got plenty of time for questions as well. We'll take those throughout the presentation. So for any questions that you have, please use the Q&A feature. You can find that at like the bottom of your screen. We try to leave the chat open for any like technical issues throughout. When you ask questions using the Q&A, you can also ask anonymously if you prefer, and then you can also upvote questions. And that way, if a lot of people have the same question, it helps us to kind of push it to the top of the list. And yes, everything will be recorded this evening. That will be sent out in a follow-up email. We will get that out in the next couple of days, which is so like give us a little bit of time to get everything processed and ready for you. And then we'll send out the recording as well as Dr. Bartels' Prezi with all the links included and some other helpful information. So with that, I want to turn it over to you, Tony, and let's get kicked off here.
Great. Well, thank you, Becca, and thanks everyone for joining. And thanks to you who registered and submitted your chief complaints, if you will. I think I saw a lot of good questions and a lot of repeat themes like public service loan forgiveness and which repayment plan to choose and should I consolidate. And we're going to definitely cover all of those topics tonight. And I know that some of you have already submitted some student debt and income signalment forms, and we've moved some of those over to the message board area, and they're pending replies. I saw that, Rebecca, and I tried to get to a couple of replies too today. That from those of you that submitted for this particular session. So we may pull those up and use them as examples since they're anonymized, but some of them are very good for illustrating some of the concepts that we're going to talk about tonight and how you should be thinking about your student loans and getting them taken care of. Ideally, you know, either before you start your internship or if you're transitioning into a residency or if you're just kind of in the midst of a residency as well, this is a great time to kind of take a good look at your student loans and make sure that they're in the status you want them to be and the one that's probably best for your circumstances. And I've got a poll that I'm going to pull up somewhere here just so I can get an idea of who's with us tonight. All right. Cool. Okay, just a couple more seconds here to see if I can get everybody to respond. All right, almost. Close enough. And that you guys should see. So most of you are just graduated or not officially graduated. So that's cool. And some other that are kind of in between here. And we'll cover all of those scenarios and make sure if we're not covering your specific scenario, ask some questions in the Q&A panel and we'll get to those for sure. All right, so let's dive in here. We want to make sure that the first thing we scratch off the list is deferment, right? Nobody should have their loans in a deferment status while they're doing internship, residency, any kind of advanced training. Now, for some of you, that may be more complicated than others. I did see a question in there, how do I get my loans out of deferment? That can be a complicated answer depending on how you proceeded with your training after vet school. But ideally, you want to make sure if you take away nothing from tonight other than the fact that you do not want your loans to be in deferment while you're doing your advanced training. Deferment is a no-no, particularly now that we have income-driven repayment options and the newest one called SAVE, Saving on a Valuable Education. We're going to talk a lot about that tonight. Actually, will cover your interest while you're doing your advanced training and while your income is relatively low. So that's going to be the one we're going to focus on the most tonight, provided you're able to use that particular plan. The only folks that it might be questionable for are those of you that are going to be in what we call the pickle, and we'll talk about that. And it just requires you to take a closer look to see if it makes sense for you to use pay as you earn instead of save. But anybody who's not in that so-called pickle, SAVE is going to be the plan that you're really going to want to get familiar with and understand how it works, because it's going to be the one that's going to save you the most money while you're navigating your advanced training and maybe even beyond. Right? There's no other way to get your interest to not accrue. So whether you have a lot of student debt or a little bit of student debt, SAVE is going to be the preferred way to take care of your loans while you're in advanced training, as long as you're not necessarily in that pickle. And even if you are in the pickle, and again, we'll cover what that is, even if you are in the pickle, there's still a chance that SAVE is going to be the best option for you, right? So it's really only those folks who are going to look at pay as you earn and decide that's going to be the best option, and you're going to have to choose that because pay as you earn is going to go away. So that's where the pickle part of it comes in. So we'll talk about all those details as we get deeper into the content tonight. And like any complex case here, we're going to have you do a physical exam of your student loans, right? While we're going through this material. Some of you have already done that. That's what those student debt and income signalment forms are all about. It's a little bit of like our intake form history. It gives us an idea of what your basic minimum database is that we can work with. And then from there, we can do some diagnostics, talk about treatment plans, and then also the side effects are going to be associated with all of those, right? So we can really approach your student loans like we do any complex medical case. Well, in this case, you guys are the complex medical case, right? You're the ones that are holding student debt. I have student debt, Becca has student debt. So we're in the same boat. So we know how to approach this, at least clinically, right? But most of us, particularly as we're just getting started in repayment, tend to approach it a little bit more like our pet owners do, right? A little bit more emotionally, right? And we got to try to take some of that emotional reactive aspect out of it and treat it more clinically, so we can, you know, do a more objective decision-making process with our student loans. And ideally, that's what's going to help reduce the stress that's associated with your loan repayment. And why should you care now? Especially for those of you going into internship residency training, because you probably don't have a time machine. Now, the Department of Education has provided a bit of a time machine over the last several years. There's been a number of benefits that allows you to kind of get a second crack at putting your loans in a position to receive the maximum benefits, and we've actually seen those benefits even extended beyond where we thought they would be just a couple of weeks ago, really. So there's a lot of opportunity here, even if you may not have done what we consider to be, quote, ideal after you graduate to handle your student loans. You've got a second crack at it, and that second crack will exist through the end of June, right? And we're going to talk about a lot of different deadlines here, and that's where, you know, the timing of this is really critical, right? So we've got a June 30th deadline, a July 1st deadline, a September 1st, let's say, signpost where the Department of Education is going to hopefully tell us all how much forgiveness progress we all have. And then November 1st is the another deadline we want to be aware of, because that's the earliest that anybody would be required to provide some income information, and for those of you that are already in repayment. So we've got these various deadlines that are approaching rapidly here this summer, but it also provides a lot of opportunity to make sure that our loans are set to be taking a maximum advantage of all of the benefits that are out there now. And this one here, this is kind of a remnant of the past, right? So we can learn from those of us that have gone and blazed this path ahead of us, and pick up some of the good things, maybe discard or avoid some of the bad things. This was one of the bad things, and thankfully is not really possible anymore. You have to really try hard to do this. But, you know, if you borrowed a certain amount and then you went into internship, residency training, and then finished that training with maybe almost double the amount that you started with, that's really hard to do anymore, thankfully, right? But this is kind of a remnant of what it used to be like if you didn't take the required steps to make sure that it didn't happen with your student loans. And thankfully, hopefully that will not be the case for anybody, at least anybody here. But for many of our colleagues, this is a much harder thing to do with a lot of the recent changes that have taken effect. So that's good news. All right, so these recent changes do provide some new opportunities. We want to make sure that everybody is aware of what those opportunities are. Just to kind of give you a view of what this looks like from repayment, for those of you that may not have been in repayment very long, or those of you that are just starting in repayment. So one of the reasons why I do this and why I'm so passionate about it is that I'm a veterinarian. My wife is a veterinarian. She's also a specialist, a small animal internist, and she's gone through the whole internship, fellowship, residency process. And we learned a lot of what to do and what not to do with her student loans during that process. But it also kind of gives us a unique perspective in terms of what, how student loans have been, how the changes have impacted not only us, but our colleagues, and what it's likely to look like going forward, at least from our student loan portfolio. And we've got a lot of it, right? So we've got, between the two of us, we've got more than $400,000 of student debt. I still see a lot of particularly new recent grads who want to be able to pay that back as fast as possible. And that's fine, but the numbers are often quite big, and that's where we do that physical exam and sometimes a sanity reality check of, okay, well, if you want to do that, and let's say that's 10 years, for us anyway, we would have had to pay $4,500 a month towards our student loans, and that really wasn't feasible. So you have to really look at what does this require, and does my budget allow for it? And for most people that are going through advanced training, you're not going to be able to make a significant payment towards your student loans. Even if you're doing a private practice internship where the incomes are relatively high, you're not going to want to use a majority of your income to pay towards your student loans. There are just better things that you can be doing with your money. And thankfully, you have all of these newer options that will help to make sure that your loans aren't incurring any additional costs while you're working your way through that advanced training. So it's just a trip through memory lane here for those of you that might not be familiar with how this system has changed over the years. We started with an initial, what's called income-based repayment plan. There weren't really any but two options out there, and this was the best at the time. And instead of paying $4,500 a month, we could pay $1,400 a month, which was a no-brainer. And since that time, we've seen a number of changes, and we've seen some new plans that were added. One of them was called Revised Pay As You Earn. And then around that same time frame, or a little bit shortly after that, we had the pandemic, which ushered in a whole host of changes to student loans. So we had a pause on payments, we had a pause on interest, and coming out of that pause, which we did recently, we've got a change. Repay has become the new save plan, and we're going to lose a couple of the previous ones, but save is generally the most beneficial these days. But there are some instances where some of the older plans like Pay As You Earn will be better than save, but it really depends on which income-driven plans you're eligible to use. And that's where this starts to get really complicated. Not everybody's eligible for the same plans, and that's where we have to dive a little bit deeper and make sure that we understand which income-driven plans you are eligible for. So we're going to talk a lot about IDR profiles tonight, which helps us to then usher you in a particular direction in terms of which strategy is going to work best. The way these income-driven plans work is you make payments based on your income for a specified period of time. And if you hit the maximum time frame and you still have a balance remaining, that's what triggers forgiveness. Right, so for a plan like SAVE, if we have graduate school student loans, which every veterinarian has graduate school student loans, the maximum repayment period is 25 years. So you make payments for 25 years, a maximum of 25 years. If you still have a balance remaining, that balance is forgiven. What's nice about Pay As You Earn and the new version of IBR, even if you have graduate school student loans, that maximum repayment period is 20 years. Right, so that's where you can start to get into comparing things like Pay As You Earn or the new version of IBR against SAVE, and we can sometimes see those plans being better than SAVE because forgiveness happens sooner. Right, so that's where we're going to start comparing those options, and there might even be an opportunity for to use a combination of them. You use SAVE for a specified period of time and then switch to the new version of IBR as long as you're eligible for it if you are on a path to reach forgiveness. Right, and that's where it becomes tricky. You have to have a bit of a crystal ball, but we have some tools on the VIN Foundation Student Debt Center where we can start to put in your student debt information, your best guess of what your income is going to do during your advanced training and then thereafter, and see if you're likely to reach forgiveness. One of the, I guess you would call it blessings and curses with the income-driven plans is as they get, quote, better, more beneficial to the borrower, the likelihood for you to reach forgiveness increases, right? So even though, you might have a relatively low amount of student debt and you're in a specialty program that might pay you a lot afterwards, there's still a really good chance that you could hit forgiveness with the newer versions of the plans because of how beneficial they are. Right. So we can use the loan repayment simulator to see if we're likely to reach forgiveness. And in those cases, we want a plan for the potential tax that we might have to pay at the end. So one of the potential side effects, if you will, of forgiveness is forgiven debt is generally treated as taxable income by the IRS and by your state departments of revenue. So it depends on what those rules are at that time as to whether or not you have to pay a tax, right? So I plan as if we're going to have to pay a tax. We're 85% towards our projected tax target with about 13 years before we reach forgiveness. And this is just a snapshot of our forgiveness planning fund, right? Just to kind of give you like a fast forward into the future, right? I don't expect anybody to be this prepared yet, right? Because most of you are still doing your training or just starting your training, but it's just to put it on your radar if forgiveness is something that is likely to be in your future and you're anticipating having to pay a tax, then you also want to plan for that. And the sooner you can start planning, the easier it is to accommodate that, right? So the dotted line here is everything we've contributed. The solid line is the value of that fund. The difference is pretty much the gains, the appreciation of that fund, which means we're using our own money to pay for that tax. We're trying to use the appreciation, the gains, to pay for a good chunk of that tax, right? So it lowers the cost of that as well, right? So again, we're not going to focus too much on the forgiveness part of things because it is, 20 years down the road for most of you. But so I'm going to talk more about what you need to do in the immediate next few months here to get your loans prepared and then put these things on your radar, and then you can reevaluate, reassess as your career unfolds. So the first step is going to be to get familiar with that studentaid.gov website, right? So most of you have done that already, particularly if you submitted that student debt and income signalment form. We're going to go to studentaid.gov, and then we're going to grab our student aid data file and put that into the VIN Foundation My Student Loans tool, right? Because that's what's going to allow us to do that physical exam of our student loans. And what are we looking for in there? These are just some of the basics that we're picking through, right? We want to understand our loan types. Unfortunately, again, just due to the complex nature of the federal student loan system, we've got a bunch of different loan types. Some of them are eligible for income-driven repayment, others are not. So we want to make sure that we accommodate all of those or account for all of those. And if we have to consolidate them, then we want to do that sooner rather than later. Right? The amounts, of course, the amounts are a big key there. They contribute to the debt to income ratio, another gauge that we use to help to decide whether or not you're likely to reach forgiveness. The interest rates play a role in that as well. Although the interest rates are becoming more and more irrelevant when you have plans like SAVE, where the Department of Education covers the interest that your payment does not. So interest rates, yes, we have to know what they are, and they play a role in the long-term projection. But the interest rates, again, with a plan like SAVE, while you guys are doing your advanced training, are not going to be particularly relevant. Repayment plan, this is where we start to uncover, what are your options? Which income-driven repayment plan profile do you fall into? Because again, not everybody is eligible for the same repayment plans, but everybody falls into one of mostly 3 groups. There are 4 groups, but hopefully there's not too many or anybody here that's in that group number 4, because that has been what we've been trying to correct over the last 2 years that the one-time count adjustment has been available. And then we also want to check and make sure we understand which repayment plan or status your loans are in. For new grads, that's going to be very important in terms of knowing when you can start a consolidation loan. But for those of you that are in repayment, I find and we find pretty consistently, people tell us they're using one plan and their file actually shows something else, right? So the details matter, right? When you say IBR and you're actually using pay as you earn, right? That's a that's a pretty big difference, right? We need to understand which plan we're in and which ones we're eligible for, so we know we're actually in the right plan, right? Or the one that's at least the best for us, given at the given time frame. Minimum monthly payments are really important too. The loan servicers make mistakes all of the time, and usually not on the side that benefits you. Right, so you have to do some math checking. We'll show you how you can calculate those payments. Just make sure that your loan servicer is getting the same number that you're getting, and hopefully, if they get a lower number than you, great, congratulations. But if they get a higher number, then you're going to want to have them correct that. Anniversary dates are really important when we talk about income-driven repayment plans, because that's what indicates when you're next due to provide updated income information, right? There's a timing component there. Income-driven repayment plans do require you to provide updated documentation of your income on regular intervals, at least annually. So some of the questions that popped up in the registration: will I be paying loans forever? No. You will not be paying loans forever. Will I ever pay it off? Yes, you will. Right. So those are easy. And now we get into some of these are more specific. How long will it take to pay off? Well, that depends. Depends on what your debt is. Depends on what your income is. Depends on which repayment plan you use. Right. But generally speaking, we know that it won't take any more than 20 years for most of you, as long as you have access to one of the plans that has a maximum repayment period of 20 years. And then, am I using the right repayment plans? Right, that depends. It depends on which ones you're eligible to use, right, and which one you're currently using, right? So these are ones that we can answer using the tools. But these are the ones that we always get that kind of fall into that, let's say, over dramatized area, right? Forever, no, right? Will you ever pay it off? Absolutely, right? So it's just a matter of what your circumstances do over time. And the secret, right? And this is really the key to understanding your student loans, right? Is you will pay your balance to zero one way or another. You will either earn enough to generate a payment that's high enough to hit a zero balance, or you will hit forgiveness, right? Either way, you're done with your student loans, right? So the key is not to pay more than your income requires you to pay, and not sacrifice other more critical areas of your overall financial wellness to pay off your loan sooner than your income requires, because your loan repayment will end one way or another, right? So it doesn't make sense to forfeit money that you don't necessarily have or could be better used in other areas of your financial wellness to pay back a loan that's going to go away one way or another. And I know that's really kind of hard for some people to wrap their head around, and particularly for maybe your mentors and your parents who haven't had access to income-driven repayment, but that's how the loans are set up, right? And your federal student loans are the most flexible but annoying debt that you'll ever have, right? So we want to make sure that we don't over prioritize them when there are more beneficial places that we can probably be putting our funds, particularly during that advanced training. Advanced training, I refer to, internship residency time is financial damage control, right? Your goal is to really get through that period without taking on any more debt, right? So you want to make sure that your student loans are in a position to receive the maximum benefit possible and the lowest payment required from you, so you stay out of other types of debt during your advanced training, right? That's the goal, to get through that advanced training. And then we can reassess your student loan long-term strategy after you complete that training, or when you have a little bit better idea of what your consistent income is going to be. So when we do that physical exam of our student loans, this is some of the things that we're looking for and what we're going to find. Hopefully, we're going to see a majority of direct loans here. If you were in higher education at any point before 2010, you might have these older federal family education loans floating around, but most of those, I think, are kind of on the way out. Perkins loans are still floating around out there. They were discontinued in 2018. Health profession student loans, loans for disadvantaged students, these are kind of the most common federal loan types that are not in the direct loan category. However, they are eligible for consolidation, right? So you can make them be part of your income-driven repayment strategy or eligible for a plan like Save if you consolidate them, right? And this is key, right? Because we're still seeing people, and I've got a good example of one tonight who graduated a year ago, hasn't consolidated their health profession student loans, but now still has a unique opportunity to get those loans into their direct consolidation loan, so they all benefit from the same types of income-driven plans and benefits that the direct loans have, right? So you won't find these last two in your student aid data file, unfortunately. So you have to account for them separately, but I'll show you how you can add them to the VIN Foundation My Student Loans tool. If you know you've got a combination of a lot of loans, or maybe you've got private loans and federal loans, and you're not really sure how to discern, you can check a credit report. Right now, you're going to have to pull this from all of the reporting entities that are out there, but you can do that from annualcreditreport.com. They let you do that for free at least once a year. I think they're still letting you do it like once a week nowadays. So you can keep tabs on your credit report and also see the outstanding lines of credit that are in your name, right? So this is a good habit to get into. This is not going to show you your credit score, right? It's just going to show you all of your open lines of credit, right? So all of the debt that you have that is not a zero balance will be on there, right? So you'll be amazed at what you find on there, and it's always a good idea to check this once a year, and particularly before you do a major purchase like buying a car or renting an apartment or buying a home. You kind of want to know what's on that credit report before the bank, because the bank's going to look, right? So if you're going to want to know what's on there, you really don't want to apply for a loan and have the bank say, hey, what's this, right? That's not a good way to learn about those things. But it's also a good way to find these loan types that you may have a hard time finding additional details on. One of the things that we're going to look at in the My Student Loans and focus on a lot tonight is your income-driven repayment plan profile, right? And there are 4 possible profiles, and I'll show you what that looks like here. So we're going to come over to the My Student Loans tool. I could back up. Let me actually, before we do that, we'll go to studentaid.gov, and I'll show you guys where the file lives. So studentaid.gov, we're going to log in here. Let me blow this up a little bit. All right, so you guys will get to see my share of the balance.
Hey, Tony, while you're working on that,
Mm-hmm.
You had mentioned direct loans. So there was a question that came in about what about indirect loans?
Indirect loans, I don't know what an indirect loan is, unless that's a loan that you receive from maybe a family member or something. But so direct loan is actually a specific type of federal loan in the system, right? So indirect loans is not something that I'm familiar with, but I'm guessing that was maybe tongue in cheek. That would be a good anti-student loan. All right, so after you log in, they're going to ask you to update your contact information. That's really good stuff to look at and review, particularly if you're changing locations, right? So if you've got a new address, if you've got a new email that you use more frequently than whatever one you used previously, you're changing jobs, or you're moving from school to your internship, or your internship to your residency, there's probably a change in email or maybe even a new phone or something like that. You want to make sure all that information is up to date, right? Because this is how they communicate with you, and you don't want to miss anything, particularly if you're applying for a consolidation loan or changing your repayment plan or something like that. So here we're on the dashboard. You can see my student loan balance. I've got a principal component. There's an interest component. Nelnet is my servicer, but this isn't really the information I need to act on my repayment plan or know what my monthly payment is or what status my loans are in. So I'm gonna hit this view details button. And I'm looking for this download my aid data button. Right now, you're probably not going to be able to see that if you're on a phone doing this, but if you're on any kind of device where it'll allow you to download a file to that device, then you should see this button. So download my aid data. It'll give you a bunch of scary language, and it'll ask you to save this TXT file. And this TXT file is what contains all of the ugly history of your higher education borrowing details with the Department of Education. And that's the file that we need. And we take that student aid data file over to the VIN Foundation Student Debt Center. So www.vinfoundation.org/student debt center. And then we come over to the My Student Loans page, right? So up at the top there, My Student Loans, it'll open that My Student Loans tool. And for those of you that are no longer borrowing, right? So maybe you're on the edge of graduating, or you've graduated, or you're already in repayment, you're going to use this box here on the right. I have graduated from veterinary school, right? You're going to take that TXT file and you're going to upload it into here. And I've got a couple of cases we're going to go through. This is the one that I think it was maybe 3 weeks ago, kind of, had a little bit of a pit in my stomach about. And then as soon as they extended the one-time forgiveness account adjustment benefit, I was super excited for them, right? Because this was a person that graduated a year ago, so 2023 DVM, has $20,000 of health profession student loans, which do not show up in here, right? So we have to add them separately, and we could do that, right? So I can hit this Add Loans button. Health profession student loan. I'm going to put the $20,000 in there. The loan servicer is usually the school or maybe Heartland, ECSI, right? And they're all at 5%. And when I add that, it'll update my student loans tool to show that balance, right? So the balance increased, right? It updates my weighted average interest rate, which takes into account the interest rates of all the different loans that I have. Right? But now I have a good picture of how much balance do I have? What's my unpaid interest number? What's my overall average interest rate? Right? But then I can start to dive in and look at some of these other parameters, right? So I see Ed Financial as my loan servicer, my income-driven repayment eligibility, right? This is how I determine my income-driven repayment plan profile based on what I see here, right? So if I come back and I'm looking at profile 1, I'm eligible for pay, what's now called save, it used to be repay, and the new version of IBR, right? So that's what is shown here, right? Pay as you earn, save, the new version of IBR. And why is that? Because they have numbers in them. Right now, this one doesn't say 100%, right? Because we have those health profession student loans. Health profession student loans by themselves are not eligible for income-driven repayment plans. But if I consolidate them into a direct consolidation loan, right, it will now be a direct type loan that is eligible for these income-driven repayment plans. So as my portfolio exists currently, 90% of my balance is eligible for pay-as-you-earn, the new save plan, and the new version of IBR. But 10% roughly, that health profession student loan balance is a non-direct loan, is not eligible for these income-driven plans. That is a trigger key for me to consolidate my loans, right? And anybody who's in this kind of a position wants to get their loans consolidated before the end of June, because that way you'll get the maximum repayment credit, right? So this person's already been in repayment for at least a year on their loans, right? They'll maintain that credit across that new consolidation loan as long as they submit that application before June 30th. And one of the other exciting pieces here in this person's history is that they have a little bit of a break in their borrowing from before vet school to when they started vet school, which tells me that they probably have even another year of repayment time, if not more, in their history that would be added as forgiveness time if they consolidate their loans before June 30th. And that's what the one-time count adjustment is all about, right? Is trying to reduce the amount of time that people have to be in repayment by taking any of their prior repayment history and crediting it as forgiveness eligible, as long as you consolidate all of those loans together. right? So this person has a really rare second, maybe even third dip at this benefit that had expired on April 30th, right? But then was extended to now June 30th, where they can consolidate their loans and potentially add not only their health profession student loans, but add an additional year plus of forgiveness time to that new consolidation loan balance, which will shorten their overall repayment time. Right. And then also, when I see their income-driven repayment profile, right, I want them to get their loans into save. I can see that they're using pay as you earn, but this particular person who has just finished their internship is now starting their internal medicine residency, really wants their loans to be in save instead of pay as you earn. And they can do that as all part of this consolidation process. Consolidate their loans, add their health profession student loans in, apply for the new save plan using their tax return from 2023, which probably shows maybe $20,000 of income on there, which will keep their minimum monthly payment at zero. The Department of Education will start covering all of their unpaid interest, so this balance will no longer grow. Right. So that's when we're looking at these files, that's what's going on in our brains, in Becca and I's brains, and when we're replying to your message board posts, right? We're looking at your history, your loan types, applying them against these opportunities you have to make sure that you get your loans into the most beneficial strategy possible to reduce the costs to you going forward as you're navigating the rest of this advanced training.
Tony, a couple of questions coming in the chat about consolidation. So I just wanted to touch on that while you're going here. Especially for those 2024 grads that are getting ready to enter an internship, maybe with residency plans as well. If that profile says 100% direct loans, can you kind of expand on still consolidating, even though they have 100% direct loans?
Absolutely, I would, because the reason you want to consolidate is because your grace period, your grace period is not helpful. Your grace period, you will still accrue there's no payment due, but you're still accruing interest and you're not getting any kind of forgiveness credit. Right. So the only way to end your grace period early is through a direct consolidation loan. Right. And this is perfect timing for those of you that have already graduated and have this opportunity to submit your consolidation application before the June 30th deadline. If you also have some prior loans that have some repayment time on them, you will actually start repayment with forgiveness credit, which is hugely valuable. Right. So I don't think there is a reason not to consolidate, particularly for those of you that have already graduated. Right. There's even a good case like this person graduated a year ago and still could benefit from consolidation before the end of June. Right. So for the 2024 grads, consolidation is a no-brainer. Right. Now, if there's something bizarre in your file or a case that you think you can make for why you shouldn't, then please post that on the message boards and try to make that case. But I have yet to see somebody where I would look at their loans and say, yeah, you probably don't need to consolidate. Right. It just doesn't exist. Now, there could have been if they didn't extend that deadline through June. Right. But since they did, it's kind of a no-brainer. Right. I mean, submit the consolidation application. It is a pain in the butt, right? It's not like an easy thing to get through. And if you have questions about it, you can ask those on the message boards. But you know, the same place that we found your student aid data file up here in loan repayment, consolidate loans, right? That's where the application is. Right. And there's really no reason for any 2024 grad to not start this consolidation application before you start that internship, right? Because there's actually even more reasons, right? So if you've got, even if your loans are all direct loans and you don't have loans from before veterinary school, consolidation allows you to end that grace period, get your loans into the new save plan, most likely with a $0 minimum monthly payment. Save will cover your interest from the time you start using SAVE, you'll start earning forgiveness credit. And if you're doing that internship or residency in an academic institution, there's a good chance that you'll be eligible for public service loan forgiveness credit too. Right? If you leave your loans in your grace period, you're not eligible for any of that other than the no payment, but you're accruing interest, which is not helpful, that you'll have to pay later. Right. So there's really no good reason to not consolidate your loans. I think I have an example of a 2024 grad, but this is another one who has some older loans that has some prior repayment time where, again, it's kind of like you run to submit your consolidation application, because the sooner you get those loans into SAVE, the sooner you'll start receiving that unpaid interest subsidy, and the sooner you'll get your forgiveness count applied. So I wouldn't hesitate on the consolidation time, no matter what no matter what your balance is, right? If your balance is 17,000 or 417,000, consolidation is going to help you, right? This is a person who just graduated, right? And this is the trigger for when you know you can start your consolidation loan, that your direct unsubsidized loans say grace period. Right, that's what makes them eligible for consolidation. But they also have some older loan types, right, and a huge break here. So maybe they finished their undergrad in 2017, started vet school in 2020. They have nearly 3 years of repayment time that will be credited as forgiveness time if they consolidate these older loans with their veterinary school loans. That new consolidated balance will start repayment with 3 years of forgiveness time, with a $0 payment in SAVE, right? That is a ideal scenario, right? You shorten your time to forgiveness, you've got a $0 payment, you're receiving the unpaid interest subsidy, and you're gonna have 4 years of forgiveness credit before you have a payment that's greater than zero. That's amazing, right? It is a huge financial benefit, not only short-term, but long-term as well, for anybody that is in this particular scenario. And this is a person who's in that income-driven repayment plan profile 1, right? So they can use SAVE, right? They have access to the new version of IBR, which provides them forgiveness of 20 years if they need it, right? But I'm not worried about that right now. I'm worried more about consolidating. I also see this is not 100%. So this person actually has an older Perkins loan, right? This one helps to illustrate a lot of these different things. This one has a Perkins loan that's still in their profile, right? Which, if they consolidate, will become eligible for that SAVE repayment plan, and all of that forgiveness time, that balance will get rolled into that direct consolidation loan balance, and 100% of that new balance will have at least 3 years of forgiveness time and a $0 minimum monthly payment using SAVE, where the Department of Education covers all of the interest, right? So again, kind of a no-brainer to get those consolidation loans started. What you're doing here is making sure that you have everything accounted for, right? When you submit that consolidation loan, my direct loans, if I've got Perkins loans, those are going to automatically be pulled into that consolidation application. But if I've got these health profession student loans or these loans for disadvantaged students, I'll have to add them manually. You could do that using the consolidation loan application electronically, right? But you want to make sure when they come back and say, hey, here's what you submitted, this is what we're going to consolidate, that there's not any loans missing from that application. That's why I say it's a little bit of a pain in the butt, right? It's kind of a accounting exercise that I know that you guys are not excited to do, but if you get it submitted and done before you start your internship, that's one less thing you have to worry about when you're, starting your overnight shift on your new internship.
Tony, could you expand a little bit on that 100% unpaid interest subsidy of SAVE? There was a little bit of confusion. There was a question that if they use SAVE, you won't be charged for interest.
Yeah, you won't. Essentially what happens, and I have this later on in the slides, but we can cover it now. If you have a $0 payment and you're accruing $1,000 a month of interest, the Department of Education covers 100% of the interest that is not covered by your minimum monthly payment. Right. So if you've got $1,000 a month that's accruing and your minimum monthly payment is $0, the Department of Education covers that $1,000 a month of interest. So it does not get added to your balance. Right. So that you will never see that that interest hit your balance, right? So that's why save, if you can use it, right, which the overwhelming majority of you probably should be able to, right? Notwithstanding the pickle, which we'll talk about in a little while, save is going to be the plan that you're going to want to be in, right? Because that unpaid interest subsidy is just crazy beneficial, right? So that it makes that interest literally go away, right? So you don't have to worry about paying for it now or later, right? Any other plan that you use, the interest will accrue outside of the payment that you're making. If you have a $0 payment and $1,000 a month of interest accrued and you're not using save, $1,000 a month will be added to your unpaid interest balance, right? So you'll have to pay that later, or it'll get forgiven later, right? So, but either way, save really helps to negate that interest that you're really not able to pay while you're doing these advanced training programs, right? And you won't have to worry about paying it later either. All right, chat poll. How much do you have to pay for your student loans each month? Kind of a conceptual question. And put any thoughts you might have in the chat. I can see some other questions here while I'm looking, but while I'm looking, hopefully you guys will have some thoughts. How much do you have to pay for your student loans each month? Yeah, Vanessa's got it. So the minimum, you have to pay the minimum, right? So what do you want that minimum to be? Right? That's what your repayment plan selection is all about, is setting your minimum payment, right? Everything that happens after that is kind of, the consequences of your repayment plan selection, right? And you have two categories to choose from, right? A time-driven category, right? So a standard 10-year plan, 15, 20, 25, you can extend it out to 30 years if you consolidate your loans. People will say, I want to pay my loans back as fast as possible. There really isn't an as fast as possible plan. You have to pick a plan that sets your minimum payment. And if you choose to pay more than that, then you might pay it off faster than what that time frame initially was. Right? Or you could choose to use an income-driven plan, right? But the reason why the income-driven plans are generally more beneficial is because the time-driven plans don't care about your income. They only care about the amount that you borrowed, right? So if you have a pretty hefty balance, which most veterinarians do starting out, you have a pretty hefty student loan balance. If you want to pay your balance to zero in, say, 10 years, then you're going to have a pretty high minimum. These are the minimum monthly payments, right? If you have $200,000 of student debt, and you want to pay that, paid off in 10 years, you have to pay at least $2,200 a month minimum to make that happen. Right? And that's usually where I see people's ideas, the ASAP ideas, kind of fall apart, right? They haven't kind of done the math on the time-driven plans to understand what does it require me to pay, right? And that's where the time-driven plans, particularly if you're earning 40 grand a year as an intern, right, is not going to work. Right, you're not going to be able to pay $2,200 a month on $200,000 of student debt when you're earning 40 grand a year. It's just not possible. Right, so that leaves you with other options. You can either extend these time-driven scales where the payments will come down, but you're going to pay a whole much more in interest, and you're still going to have a relatively annoyingly high minimum monthly payment. The income-driven plans, where only your federal student loans are eligible for those types of payments, right, are hugely beneficial because they take your income into account when they calculate the minimum, right? The amount that you have to pay while you're doing an internship, residency, advanced training, right? So if you're earning 40 grand a year, your payment's going to be reflective of the fact that you're earning 40 grand a year, right? Or because of how the income-driven plans work, they will always take your last year's, your most recently filed tax return, right? Which for many of you is very low, no matter where you are. Right, and that's what can help result in a $0 minimum monthly payment. Right, your income has to reach a certain threshold before it actually triggers a payment that's greater than zero under an income-driven plan because of how the calculation works. And we'll get to that in just a second. right? But that's the value of these income-driven plans, particularly why you have a very low income, right? Is that if you have a very low income, you don't have to worry about having to pay a huge payment towards your student loans, because if you're using an income-driven plan, your income will reflect, that payment will be reflected of your income, right? And that's where the differences come in, right? So different plans have different formulas for calculating that minimum monthly payment, right? And this is what it used to look like. This is what it looks like now. So revised pay as you earn turned into save. They're going to phase out pay as you earn, the original income contingent repayment plan, which nobody here should be worried about. And then it essentially made the old version of IBR, the version that my wife and I started using, obsolete, right? So there's no reason to start with an IBR plan, right? Some of you may end up in an IBR plan later on down the road, but there's no reason for anybody to start in any of the plans that are named income-based repayment, right? You're going to ideally start with save, maybe pay as you earn, right? Depending on your income-driven repayment profile. And for those of you that are eligible for the new version of IBR, there's an opportunity for you to use save for up to 5 years to receive the unpaid interest subsidy, and then consider switching to the new version of IBR. There's actually a restriction on switching where you can only do so if you have less than 5 years of payments in save, right? But again, that's even 5 years is too far down the road, right? Use save, make sure that you're in it while you're doing your training, and you won't have to worry about that interest accruing. And then when you finish your training, right, then you can maybe think about switching to the new version of IBR. The other reason why you want to use an income-driven plan instead of any other type of plan is because they're the ones that are forgiveness eligible, right? Now, you never know when you're going to need forgiveness, right? It really depends on what happens over your career and how much you earn, right? But there's probably going to be some ups and downs, right? You want to log that forgiveness progress. So if you need forgiveness down the road, it happens sooner rather than later. If you're using some other plan that's not forgiveness eligible, then you're not going to log that forgiveness progress, which means you'll be in repayment longer if you eventually do need forgiveness. Just because you use a forgiveness plan doesn't mean you're automatically going to hit forgiveness. It just makes it possible, right? So you want to log that forgiveness progress, get as much forgiveness time as you can, just in case you need it later. Now, the 10-year plan is also forgiveness eligible, but it comes with a honking high payment, right? So it really doesn't make a lot of sense to try to get a forgiveness eligible payment with a standard 10-year plan. And none of these other ones are forgiveness eligible, right? But the income-driven plan payments are. All right, so how do they calculate your monthly payment? Right, so here's the difference in the payment calculations, right? So they take a percentage of what's called your discretionary income. And discretionary income has some different formulas depending on the plan that you use. Right, so generally speaking, they take your taxable income. So this is where that tax return comes into play. It's easiest, it's not necessary, but it's easiest to pull that adjusted gross income number right off of your recent tax return to satisfy this equation, right? So they will always accept your recently filed tax return adjusted gross income as the valid input for this equation, no matter what the number shows, right? Even if it's really low or zero or maybe even negative, and your current income is not, they will still take that prior filed tax return as valid income documentation for these calculations. They will then subtract off an allowance, right? So 150% or 225% of the federal poverty guidelines for your family size and state of residence. If you can look these up, it's on the HHS website, right? But this is what requires you to have a certain amount of income before it even creates a payment that's greater than zero, right? Because they subtract off this designated allowance as your essential living expenses, if you will, that isn't counted towards your monthly payment for your student loans. The bigger this factor that they multiply, the more they subtract off your taxable income, the lower your payment, right? So save has the biggest factor in that equation. So it has the lowest monthly payment compared to any of the other income-driven plans, which is another reason why save is so beneficial. So save, they will take 5 to 10% of your discretionary income, 10% for those of you that have graduate school student loans, 5% for those of you that only have undergraduate loans, but that's not any veterinarian, right? So every veterinarian is going to be closer to the 10% than the 5%. 25-year maximum repayment period, 10% of discretionary income for pay-as-you-earn or the new version of IBR, but they use the 150% allowance factor, right? So the payment will be a little bit higher there. And then the old version of IBR, this is why it's obsolete, right? It's 15% using the 150% factor, so the payment's quite higher than any of the other repayment options. Save is the only one that has 100% unpaid interest subsidy. None of the other plans have an unpaid interest subsidy, which means if your payment is less than the interest that accrues, that amount gets added to your unpaid interest balance. So if we do an example, and if we just take kind of a average internship income these days of $50,000, if we do the calculation for save, we subtract off 225% of the federal poverty guidelines for a family size of 1 in the lower 48 states, we get a discretionary income of $16,000. If we take 10% of that, divided by 12, the minimum monthly payment is $134 per month. And so that's how they calculate your payment using that formula. So how much should you pay? Pay what your income requires you to pay. Right? It doesn't make sense for you to pay more, particularly while your income is relatively low. Pay the minimum, let the Department of Education cover the interest via this unpaid interest subsidy, and you'll pay less in total when your income finally does increase. Right? So there's no reason to worry about paying more than you have to while you're navigating your advanced training. So what happens down the road, right? So if you bump up against one of these maximum repayment periods, right? So 25 years for save, 20 years for pay as you earn, or the new version of IBR, any balance that you have remaining is canceled, right? i.e. forgiven, right? So you get a 1099-C in the mail that year, indicating how much of your debt was canceled on your behalf. And depending on what the rules are in place at that time will determine whether or not you have to pay a tax on that. Right now, we're in a tax exempt period for any student debt that is forgiven or canceled in the tax years 2021 through 2025. Now, there's been a good number of people who have received forgiveness through the one-time forgiveness count adjustment, right? But this is really going to depend on what Congress decides to do in 2025. 2025 is going to be a huge year where Congress has a lot of big decisions to make about tax policy. And this is just one of the provisions, right? So this will either get extended or it will expire, right? So if it gets extended, it probably will get extended in like these 5-year increments like they did here, or it might just be left to expire. But since nobody knows what is going to happen in 2026, if you're going to experience student loan forgiveness in 2026 or beyond, like my wife and I are expected to, we're going to plan as if we have to pay the tax until we know otherwise, right? So, but this has opened the door to forgiveness, student loan forgiveness specifically, being tax exempt in the future. And how does the tax work? You get taxed at the marginal income tax rate, right? So whatever the tax rates are at the time, right, federal, and if you live in a state that has state tax, whatever those tax rates are at that time and whatever your income is in that year, including the amount that's canceled, that's what determines how much you would pay in tax. You only pay a tax if you have a balance remaining, right? So again, you can use an income-driven repayment plan, still hit a balance of 0 before you hit forgiveness and not have to worry about paying a tax, right? So, just because you use a forgiveness plan doesn't necessarily mean you will have forgiveness or have to pay a tax. People refer to it as a tax bomb. Is it a penalty? Is it a discount? For those of you that don't know, the top marginal tax bracket in this country is currently 37%, right? Getting a 63% discount on something is a pretty good deal, right? So just because you might have to pay a tax on your student loans doesn't mean it's something you should avoid. Right? It's generally speaking, if you're projected to hit forgiveness, even if you have to pay a tax, you're probably going to pay a heck of a lot less than if you tried to pay that balance to zero. Right? So it's just the way that the plans are structured and how it works out. And that's what you can learn in the student loan repayment simulator in terms of whether or not you're projected to reach forgiveness. Public service loan forgiveness is a whole different beast, right? There's some overlap and they're related, right? In terms of how the income-driven plans are required in public service loan forgiveness, but it's a completely different type of forgiveness. So public service loan forgiveness is tax-free, right? By law, right? But you also have to do a few different things, right? So the things that you have to do is have the right loans, so direct loans only, in the right repayment plans. Income-driven plans qualify. Again, that standard 10-year plan qualifies, but it's not a very good plan to use if you're anticipating hitting public service loan forgiveness. But you also have to be working at full time, which they define as an average of 30 hours per week for an eligible organization, most likely a 501c3 nonprofit or some kind of government entity. Right? If you're doing all three of those things, then you're earning public service loan forgiveness credit. And as soon as you hit 120 months of public service loan forgiveness eligible payments, you can apply to have your loans forgiven under public service loan forgiveness, which means they would be discharged tax-free. They don't have to be consecutive, right? But you're going to have, because you're using an income-driven plan, you're going to have two different clocks ticking at the same time, right? You're going to be using probably SAVE as your qualifying repayment plan, which has a 25-year forgiveness clock associated with it. But if you're, for the months that you're also working for an eligible employer, you're also at the same time receiving public service loan forgiveness eligible credit. And if you hit this 120 months before you hit the 25 years in SAVE, then you can receive public service loan forgiveness. But if you hit SAVE before you hit the 120 qualifying public service loan forgiveness credits, then you would trigger the SAVE forgiveness instead. Right? So they're related, but they're very different. And those of you that are doing internship residency training, right, a lot of this time can be eligible for public service loan forgiveness. So academic internship, all of them should be eligible. Academic residency, in my opinion, all of them should be eligible, but I don't get to sign the forms, right? But hopefully you can find somebody there that would be willing to sign off on your public service loan forgiveness employment certification form, right? So that's what it requires, is somebody to say, yes, they meet these requirements, right? And sometimes you'll find some sticklers at some of the academic institutions who don't like this definition of full-time employment for their residencies, but generally speaking, you can and should be able to find somebody there that's a little sympathetic to that, right? So keep shopping that form around, right? More and more residencies seem to be producing people who have public service loan forgiveness credit. It's variable, and it really depends on who you find there to sign that form. So when you're courting those residencies, go meet with their advisor or the equivalent HR rep and show them that public service loan forgiveness employment certification form and ask them if they've signed them before, right? Are you going to be the first person blazing this trail, which might make it a little more difficult, or are they pretty familiar with it and they're on board, right? So those are just some things that I would do if I were trying to get that public service loan forgiveness credit. There's the link to the form, and you never know where your career might take you, right? So a lot of the, just by nature of how the advanced training is set up in veterinary medicine, a lot of it runs through these public service loan forgiveness potential eligible pathways, right? So whether or not you have zero intention of staying in a nonprofit after you finish that training, you never really know where your career is going to take you, right? So you want to log that time, again, just in case you find yourself in a position to need it or use it later on down the road, right? So this is one of those reasons too why you want to get your loans consolidated and into an eligible repayment plan, ideally before you start an internship or residency, right? Because that grace period doesn't count as public service loan forgiveness time, even if you are working for that eligible employer during that grace period. Right? That grace period is kind of a no man's land. And the only way to end that grace period is by consolidating those loans. This is a veterinarian who a few years ago now received more than $430,000 of her loans erased through public service loan forgiveness. Right, so this is happening. I know there's a lot of horror stories out there, but it's also nice to see those success stories in public service loan forgiveness.
Actually, Tony, can you expand a little bit on that? Because there was a question earlier about, I keep hearing about there being a percentage of people who are not forgiven at the end of the 2025 years on an income-based repayment plan. Can you expand on this? Is there any way to know what, if you will or will not have something forgiven?
Well, that's what the count adjustment is all about, right? And that's really that was kind of the original sin for income-driven repayment, is that there wasn't a very good accounting system for logging eligible income-driven repayment payments. Public service loan forgiveness has had a accounting system since about 2013, which was late, right? And that's what some of the original problems were with public service loan forgiveness, is we didn't have a really good accounting system until 6 or 7 years after it went into effect. And now the same thing is happening with income-driven repayment, right? So we've had income-driven repayment since 1994, but nobody's added a counting system until now, right? So with the counting system, with the ability to be able to see how much qualifying forgiveness time you have, it'll be much easier for you to not only, challenge any mistakes there, but also help you know how much time you have until you do reach forgiveness. Right now, the people that are reaching forgiveness this year and will reach forgiveness next year are nearly all due to the one-time forgiveness count adjustment. Right, so the income-driven plans have really not been around long enough to generate mass forgiveness in 2025, right? But with the one-time count adjustment, it is. So we are going to see a lot of people, but that one, again, because of that's a special nature there, where they're kind of going back in time and combing through all of your ugly history and giving you credit for repayment time and some deferment and forbearance time, and that's really messy. But going forward, it should be much more straightforward for you to log the time and see the time that you have that's credited towards forgiveness, so you have a much better idea of when you're going to hit forgiveness. And public service loan forgiveness, if you use that employment certification form, it will show you that public service loan forgiveness credit in your file, right? So I actually have that in, let me see where that is. Here, let me just click on this link and then I'll get me back into the universe. So in your student aid data file, if you're one of those people that has been applying for public service loan forgiveness credit while you're doing your advanced training so far, you'll see it. There's a public service loan forgiveness status tab. Now, this person doesn't have any public service loan forgiveness credit logged here yet, but if you did, you would see it. You'd be able to see it in your file. And this is what I suspect your income-driven repayment forgiveness will look like too, once that number is formally applied to everybody's data file, which is supposed to happen by the end of this summer. Or not quite the end of the summer, by September, right? So that's logistically what it's going to look like, right? But one of the reasons why we have had so many issues with people actually receiving forgiveness is because of the lack of that count in the being available to people to see. All right, let me hit that. Oops, just trying to get rid of these. See if I can get my window back to normal here. I don't know what's going on there. All right. Find where I was. Any other questions while I'm fishing around in here?
Yeah, let me try and focus on some of our most upvoted. So they might be a little bit back, but should you consolidate your loans if you are already in the save repayment plan and your interest rates range from 5.3 to 7.6%?
So it depends, right? So I'll say a couple of things there. Your interest rate has no bearing on whether or not you should consolidate. You will pay the same amount of interest whether you consolidate or don't consolidate. So your interest rate is never a factor in whether or not you should consolidate. The factors that do matter when considering consolidation are whether or not you have something to gain. So if you can add a health profession student loan into that balance, if you can end a grace period, if you can add additional forgiveness time, then absolutely yes, consolidate. Right? If all of your loans are 100% of your loans are direct loans and they're only from vet school, and consolidation will not add to your repayment time or not add any additional balance that otherwise wouldn't be eligible for an income-driven repayment plan, then you don't have to do it. Right? So that's the only consideration there. No matter what or how different your interest rates are, that has no bearing on whether or not you consolidate, right? But that is probably, and thank you for giving me a chance to point that out, because that's usually how most people make their consolidation decision, is that they look at their loans and they see one loan has a high interest rate and they don't want to combine it with a loan that has a low interest rate. That does not matter at all, because the way that they calculate your interest rate when you consolidate, it's a weighted average, which means you're paying the exact same amount of interest whether you consolidate or you don't consolidate, right? So it does not matter if your interest rates do not matter in the consolidation consideration.
There's another question here about, is there any catch to consolidation, or is it only beneficial to us?
So I have a pros and cons of consolidation. Let me come back to that when we hit that. The one negative, I'll say two negatives. Two negatives is the application. The application sucks, right? It's complicated. You're going to have a lot of questions, but ask if you have any questions, right? But that again is not a reason not to consolidate. So it's a small administrative burden to submit the application and make sure everything goes as planned. The second con of consolidating is unpaid interest capitalization. But most of you, because of the pandemic forbearance benefits, don't have a lot of unpaid interest. So again, that's not a reason not to consolidate. However, it is another reason people use to not consolidate, because when you consolidate, they will take any unpaid interest and add it to your principal. Right? But again, most of you, the files that we've been looking at the last several years, have very little unpaid interest, and it's not going to have any bearing on your long-term repayment cost, because the benefits of consolidating outweigh the negative of the capitalization in the overwhelming majority of cases.
One more pretty upvoted question here is, I did not file taxes in 2023. Will that be a problem when we're talking about consolidation, selecting a repayment plan?
Yeah, it's a let's call it a complication. If you don't have a recent tax return on file, you're going to have to provide some other type of income documentation. So either a recent pay stub, or if you haven't started your internship yet, then you can actually say, I don't have any income, because you don't yet have any income because you haven't started that job yet. So there's a checkbox on the application that can still allow you to get a $0 payment as long as you submit that application before you start your job. Right? Once you start your internship or your new job or whatever you're moving to, right, then you lose the ability to say that I don't have any taxable income. Right? But if you're in between positions right now and you actually don't have any income, you can check the box that says I don't have any taxable income, and that will set your payment to $0 for the next 12 months. So so if you don't have a tax return, you either have to check that box that says I don't have any taxable income, if that's true, and if not, then you have to use some kind of pay stub that will fill in that taxable income input in that calculation. So having that tax return on file is the easiest and cleanest way to get into repayment, but if you don't, there are options for that. So some feature differences between the income-driven plans. The lowest payment is going to be SAVE. In some rare cases, probably not for any intern or resident, in some rare cases for people who have very, very low balances, you might see that the standard 10-year plan minimum payment is lower than your SAVE payment, but probably not, right? So that's pretty rare, but can happen. Shortest time frame is going to be pay-as-you-earn, new version of IBR, public service loan forgiveness if you did it in 10 years. The best unpaid interest handling, right? So that was probably the most common concern voiced by everybody who submitted their registration for this webinar was how do I reduce the interest? SAVE is the answer, right? Saving on a Valuable Education, the name of the new income-driven plan, SAVE, has that 100% unpaid interest subsidy, means any amount that is not covered by your minimum monthly payment is covered by the Department of Education. The most flexible strategies, SAVE for up to 5 years if you're eligible, switching to the new version of IBR. Pay-as-you-earn if you're not eligible for the new version of IBR. You can use SAVE all the way to 25 years. There's nothing wrong with that too. SAVE till you reach public service loan forgiveness. Or if you have a very low debt to income ratio, a standard 10-year plan might actually get you to zero the soonest and in the least expensive manner. But again, that's really for very, very low debt to income ratios. It really depends upon what your income-driven plan profile is, right? And that's where my second poll is. Let me find that one. All right, I'm hoping, I might ask you guys this one again, that you guys have been walking through this process, grabbing your file, looking at your income-driven repayment eligibility using the My Student Loans tool so you can see what your income-driven plan profile is. I see a great question here from Lauren while I'm waiting for the poll to go. That's in the chat. I'm in a specialty internship and I've been in pay-as-you-earn since I graduated 2 years ago. So my loans will automatically go into SAVE because I'm already in an IDR plan because pay is being phased out, or do I need to apply for SAVE? So yeah, that's a great question. So your loans will not automatically go into SAVE unless you are using Repay, which was the predecessor to SAVE. If you're in a plan other than Repay, you would have to physically apply for SAVE, right? But I'd also want to first, particularly Lauren, in your case, know if you're in the quote pickle, right? So that's and that's related to this question that we're asking in the poll right now. Are you in that income-driven repayment plan profile 2, where you're not eligible for the new version of IBR, which means if you leave pay-as-you-earn, you will no longer be able to get back into it after July 1st, right? So that's where we want to just double check, right? Is it safe for you to move from pay to SAVE? And by safe, I mean you're eligible for the new version of IBR, which means you're in income-driven plan profile 1, means you can safely move from pay to SAVE and still have a 20-year forgiveness option if you need it because you're eligible for the new version of IBR, which you could switch to down the road. But if you're in the pickle, meaning you're not eligible for the new version of IBR, if you leave pay-as-you-earn, after July 1st, there is no 20-year forgiveness option available to you any longer. Now, that may not matter, right? It depends on what your balance is and what your specialty is and your likelihood to reach forgiveness, which means SAVE would still be a good decision for you, right? But if pay-as-you-earn is going to result in forgiveness and a lower cost profile than SAVE would, you may want to stick with pay-as-you-earn. That's how we kind of work our way out of the pickle, so to speak, right? Is comparing those things, right? So first thing, automatically no. If you're in pay-as-you-earn, if you need to get into SAVE or want to get into SAVE, you would have to apply for it. But if you're in the pickle, just know that you won't be able to get back into pay-as-you-earn after July 1st because it's being phased out. All right, so it looks like there's a few people that are in the pickle, and my goal is to reduce the number of people who are in the I don't know category, right? But most of you, and this is what I suspect, will be in this IDR profile 1, which means you can safely use save, right? So whether you need to consolidate before you pick save or just apply for save, great, right? But if you're in the pickle, we'll talk about that a little bit more here going forward. You do have to provide annual income documentation, right? So that's kind of the price of admission for income-driven repayment plans. So every income-driven repayment plan, or anybody who's using an income-driven repayment plan, will have an anniversary date, right? That signifies that 1-year anniversary of your current payment schedule. Right, so if I come back to one of our examples, that first one, the person who graduated in 2023, if I go into the loan groups here, they're using pay as you earn, right? Their anniversary date is September of 2025. Now that's more than a year from now, right? These anniversary dates got a little bit prolonged because of the pandemic forbearance benefits, right? So we're still kind of working through that adjustment period for the anniversary dates, which is why we can see some of them that are further out into the future. But as we discussed with this person before, right, because they're eligible for the new version of IBR, they want to get out of pay and into save. And Lauren, this may be your same situation too, right? It really depends on what your income-driven repayment plan profile is. But if you're using pay as you earn and you're eligible for the new version of IBR, then it's a no-brainer to switch from pay to save. Now, this person, because they graduated in 2023 and just finished an internship, I'm guessing that their 2023 tax return shows a pretty low number, which means they can probably still maintain that monthly payment of 0 even when they switch, and their anniversary date will get kicked probably till, I don't know, May or June of 2025. So in this instance, it's kind of weird. Their anniversary date would actually come up sooner because they would switch plans, right? So the anniversary date is the date by which you absolutely have to provide updated income information. Actually, the new rules that just kind of took effect are that you have to provide that income documentation 35 days before this anniversary date, which I think is terribly confusing and really stupid. But we're going to put some notifications in here, right? So right now we'll tell you when your anniversary date is, and hopefully in a couple of weeks or a month from now, you'll also be able to see what 35 days is before this anniversary date, and then maybe even add some reminders to your calendar, right? So just trying to help you not miss these anniversary dates, because this is this is a pretty common occurrence, is people forget to provide their annual income information, and then your payment jumps up to something that would mimic a standard 10-year plan payment if they don't get any updated income information from you, right? So we're going to try to make it easier for people to not miss these things, but just because their dates, it's inherently easy to screw them up. So 35 days before these anniversary dates is when you absolutely have to provide that annual income information. You generally want to use that most recent tax return unless that most recent tax return is higher than your current income, which can happen, particularly these days, if you're going from a private practice internship to an academic residency. Right, so we've got an interesting dynamic going on in veterinary medicine right now, where private practice internships are paying much higher salaries than academic internships and academic residencies. So you could very well see yourself taking a pay cut moving from a private practice internship to a private practice residency, which means you would want to use that new academic residency income instead of your private practice, maybe tax return, right? So that's an example of when you would not want to use your adjusted gross income, and you might instead want to use your new academic residency income as income documentation, so you get an even lower payment, ideally using save.
Great question here. What if our anniversary date is in the past because of the pandemic?
You add a year to it until you get beyond at least November 1st, right? So no one has an anniversary date before November 1st. And if your anniversary date is actually in the past, then you should add a year to it until you're beyond November 1st of 2024. And that should be your new anniversary date, though you'll want to double check that with your loan servicer, right? But if it's in the past, it just means that it hasn't been updated yet in the system. But the way that the system is, at least it's described outwardly to those of us that can read this information, is that it shouldn't be any sooner than November 1st. And then you could pretty much keep adding a year to it until it gets beyond that date. All right, what about deferment, right? So I mentioned deferment is a no-no, right? You really want to stay away from it, right? And deferment is kind of that conventional wisdom in that medical training community where it's like, oh, what do I do with my student loans? I don't have to pay them. Well, I call and request a deferment. And that's just, you don't want to do that, right? That's going to have you rack up a whole bunch of interest. Your loans are not going to earn forgiveness credit. You're going to be in repayment longer, and you may even see that interest added to your principal, right? So you really want to use these income-driven plans. That should actually say save. I thought I updated all these, but I missed one. So anywhere you see repay also means save, but save ideally, pay as you earn if you're in the pickle, and pay as you earn is going to work better for you. But those are going to be way better than deferments, whether you're doing an internship, residency, family leave, medical leave, changing jobs, whatever the case is. You don't ever want to defer your loans after you get out of school. For those of you that, how do I get out of deferment, right? That's a kind of a special case. Right now, this pops up occasionally, and it's really for those of you that go directly from vet school into either a grad program like a PhD, or for those of you that go directly into an academic residency, which there's a few of the specialties where that's possible. But if you enter an academic program while you're in your grace period, your loans will get stuck in an in-school status until you're done with that experience. This is another reason why you should be running to consolidate your loans immediately after you graduate and your loans enter that grace period, right? And these are really rare, but when they do happen, they're really consequential, right? So if, the classic examples of those of you that graduate from vet school, go into a PhD program, or go into a ClinPath residency or a lab animal residency at an academic institution, and you start that experience in August, after you graduated in May, your loans from vet school are still in their grace period. That just continues, just like your loans were handled while you were in vet school. Right, it's very, very, very difficult to get those loans out of that in-school deferment status. So the best way to do that is to take advantage of your grace period while you have it, consolidate your loans, end that grace period. Once they're in a repayment status, you can voluntarily end any kind of automatic deferment that they apply later. But you can't end the automatic deferment of a loan that's never been in repayment. Right? It's stupid, but it's just part of the system. Right? And these can be really, really, really consequential, right? Particularly for those of you in those PhD programs, which can last like 7 years. Right? 7 years of interest on a veterinary school size balance is a lot of interest. Right? So it's really imperative that you consolidate your loans and encourage your colleagues that might be entering these programs to consolidate their loans before they start them, so they don't end up in that in-school status that they cannot end. Some of you will experience this anyway, right? So let's say you graduate, consolidate, put your loans into save, and eventually find yourself in an academic program. The system will want to automatically defer your loans, just like they did when you were in vet school. But the difference here is you can end that, or you can waive it. You can say, look, hey, I know you're going to try to defer my loans, but I want to keep them in repayment because I can choose to do that, right? But you can't choose to do that if your loans have never been in repayment before, right? It's a subtle difference, but it's a consequential one, particularly for those of you that are doing these kind of longer programs where your loans can get stuck in that status for a long time and accrue a lot of interest. Right now, ideally, when you start those programs, you start like the example I've been using. academic internship rolling into an academic residency, most likely that academic residency is going to have some kind of master's of clinical science or something associated with it that's going to want to automatically defer your loans, right? And this is for those coordinators out there, right? You want to make sure that you have those folks call their loan servicers and tell them ahead of time, don't put my loans at a deferment. I want to keep them in my SAVE, my income-driven repayment plan, right? Ignore the deferment. And once you do that, they will ignore that status going forward. But you have to keep an eye on that, right? Especially when your payments are zero, it can be very difficult to tell the difference between a deferment or a $0 minimum payment using SAVE, right? And they're very different in terms of forgiveness and how the interest is treated, right? So check in periodically on your loans to make sure that they're actually in a repayment plan and not in deferment. All right. Okay, so let's talk. We're going to finish up here just talking about strategies. So what's the best way to repay your student loans? Now, we've kind of covered this. There's a little bit of a difference between handling your student loans while you're doing your advanced training and then repaying them when you have a, more of a market-based income, right? So post-training. And even then, right, the best is not always the fastest, and the fastest is not always the cheapest, right? It's going to depend on how long it takes you to get through your advanced training, how much forgiveness time you've racked up, and what repayment plans you're eligible to use. Right? Again, these plans, they change, but they've only gotten more beneficial rather than less. And the more beneficial they get means the more likely it is you'll reach forgiveness, even if you have a very, very robust income. Right? I was just working with a veterinary surgeon who has been in repayment for 10 years and is earning $450,000 a year, which is great, right? But he's still going to hit forgiveness because of how much time he has logged towards forgiveness, and because he's actually using pay as you earn, which will cap his payments at the standard 10-year plan, no matter how high his income gets. So he's going to hit forgiveness if he chooses to. Right? He could choose to pay his loans to zero too if he wants to, but he'll pay more if he does that. Right? So it's really amazing how these plans can work out, even if and when you end up earning a whole boatload of money. Right? So you just want to make sure you take a look to see. And I'm super excited that he asked, because we've been working together since he's been doing an internship, and now he's checking in well post his training and trying to understand what he should do. And it's pretty amazing to see that you can earn that kind of income and still hit forgiveness, right? But that's just how the plans are structured, right? And how his circumstance is playing out, right? So again, just don't assume just because you finish your training and all of a sudden you're earning, $200,000, $300,000, $400,000 a year, that these income-driven plans you have no use for them anymore, right? There's a really good chance that you're still going to be on a path to reach forgiveness, depending on which plans that you're eligible for and which plans you're using. So the best strategy, in my opinion, is one that helps to reduce the risk to myself and my family, right? Again, your student loans are the most flexible but annoying debt you'll ever have. And this is part of the flexibility, right? If something happens to you, nobody else is ever on the hook for your student loans, right? Even if you're married, have kids, whatever. If I get hit by a bus tonight, my wife, my daughter do not have to pay for my student loans. They go away with me, right? So again, I don't have to race to a zero balance because I don't want to have to leave them stuck with my student loans, because my student loans are going away if I go away, right? So that's a huge benefit, right? That might not feel like one, but when you start to have a family, it does, right? It's a pretty big deal. Maximizing my monthly cash flow. Again, I'm not going to pay more than I have to towards my student loans, because I can take that additional money and do better things with it, right? So if my income requires me to pay X, but it would be Y amount higher to hit zero, I'm not going to pay the Y amount, because I can actually do better things with that money over the long term that will will result in a better overall financial wealth and wellness, right? So there's not a lot of real compelling reasons to race to a zero balance on your student loans, right? Until you reach a point where you have so much money that you literally have nowhere else to put it, maybe then, right? But, you know, I don't find too many people that are in that scenario. So congratulations if that is you in the future. And then ideally, I want to reduce my total repayment costs, right? Just like the example I was using with the surgeon who has, 10 years of forgiveness time already and is going to have his payments capped using pay as you earn. That's going to actually reduce the amount that he's going to pay in total, rather than trying to pay the balance to zero, which would voluntarily increase the total amount that he pays towards his student loans. Right. So there's a lot of reasons to just understand the income-driven strategies so you don't end up paying more than you have to or taking on undue risk for yourself and your family. And this is the one that I've been asking a lot lately. You know, what happens if you don't pay your student loans fast enough? Right. So, but this is a chat question, right? So what happens if you don't pay your student loans fast enough? And then I'll kind of look and see if I missed any questions in the chat here. What about us with private loans as well? Yeah, private loans, they behave completely differently, right? So private loans, unfortunately, are not nearly as flexible as your federal student loans. Same applies to those of you, we've been getting a lot of questions lately about Canadian student loans. Now, Canadian student loans do have some of them, and I know not very much about Canadian student loans, but I do know that some of them do have some income-driven components, but it's a completely different system. So, any of these other loan types, private loans, other government loans that are not U.S. federal student loans that do not qualify for income-driven plans, those are all governed by the master promissory notes, the contracts that you signed when you took those loans, right? And you're kind of bound by those contractual terms. Now, private loans, you can sometimes refinance them to maybe get a better interest rate or better terms, but you have to be very careful there too. They often entice you to bring a co-signer, a family member, a spouse, somebody to the table, which puts them at risk for your loans if something should happen to you, right? So that's where, I come back to that your federal student loans are the most flexible but annoying debt you'll ever have. And private loans just don't have these types of provisions. So if I have private loans and federal student loans, I'm going to get my federal student loans into the most beneficial plan and strategy as I can, and try to eliminate those private loans as quickly as possible. Right. So private loans, unfortunately, just don't have the options and provisions available that the federal student loans have. You cannot consolidate private loans with federal student loans. So you can consolidate private loans into a new private loan, which is essentially otherwise known as a refinance. Right. You would only do that if you were getting some kind of better terms and conditions. Right. So, but a federal consolidation loan is completely different than a private consolidation or a private refinance. Right. So hopefully that's clear. But yeah, unfortunately, no, those private loans are way less flexible. So anybody have any thoughts? What happens if you don't pay your student loans fast enough, your federal student loans fast enough? I will just take that as everybody knows the answer, which is nothing. Again, coming back to the secret, you're going to pay your loans to zero one way or another. Either you're going to earn enough where you'll hit a zero balance before you hit forgiveness, or you'll hit forgiveness. Right? There is no negative consequence other than the self-imposed ones of, oh God, I've got this debt and I've got it forever, that we put on ourselves. Right? But those loans are going to go away one way or another. So the best strategy for you to pursue if you're just graduating, consolidate. Even if you didn't just graduate, if you missed an opportunity to consolidate and it would benefit you to consolidate, then consolidate now before the end of June. Do not defer. Use an income-driven repayment plan. Ideally, save unless you're in the pickle. Save has that beneficial unpaid interest subsidy. You do not want to make extra payments while you're using Save. We're going to talk about that in just a minute here. But anybody that's doing an academic internship or residency should be submitting that public service loan forgiveness employment certification form just to see if you can get some progress towards public service loan forgiveness in case you need it. And then depending on what your income is post-training, then I would do another check-in, right? Make sure that you understand your options, your likelihood to reach forgiveness. It may not make sense to just start plowing a bunch of money into your student loans to pay them to zero just because you're earning more money as a specialist. So advanced training incomes, this is the most recent data that's out there. Internship average, you got to be a little careful there. $53,000 a year is the internship average across all internships, but private practice is the majority of those, and private practice internship incomes are much higher than academic internships. Almost, it's sometimes double. So it really depends on which type of internship that you're doing. Post-internship average, anybody's guess. I pulled the 120,000. That's the mean that was posted for the Bureau of Labor Statistics across all veterinarians nationally for 2023. So it really depends. If you do an internship only, there's not a lot of data that suggests that you're going to earn any more than somebody who didn't. So that's where I just use the median income number from the BLS there. Residency average, most residencies, and this is how you could end up with a pay decrease, most residencies are in academic institutions, right? So most of them have a lower salary than those private practice, the fewer private practice ones that are out there. So you could very well go from a higher paying private practice internship to a lower paying academic residency, which is kind of a flip numerically that we've seen over the years. And then specialty averages, oof, man, good luck finding that data. So there's some scant information on what specialists earn, but it's very inconsistently updated, unfortunately. So I would really go knock on the doors of the specialty colleges and get them to commission some more regular periodic reports on that to see if we can get some better data. But right now there's not a lot, that's not a lot available. Should you consolidate? So here's the pros and cons that I was talking about, right? So if you want to see what the pros and cons actually are, this is what they are listed out. But again, I cannot think of an example where I've looked at somebody's loans and said, oh, why did they consolidate? Right? You're nearly always better consolidating than not, right? The only exception to that is if you've got nothing to gain from it, right? Don't waste your time doing it. But if you have something to gain, then none of these cons are going to outweigh any of those gains. So if you're on the fence, ask, but generally speaking, you're probably going to want to consolidate and do so before this June 30th deadline. And this one-time count adjustment, I mean, this is like the craziest benefit that we've seen for federal student loans, right? To go back in time and to give everybody who has these federally held loans, the right loan types, forgiveness credit for any prior repayment time and even certain deferment and forbearance time is crazy to think about, right? And this is why we are seeing people receive forgiveness now, is because people that have been in repayment for 20, 25 years are receiving this one-time count adjustment, eclipsing that 20 or 25 year forgiveness threshold and having their loans forgiven, right? But it also means that there's benefits for those of you that have older loans that have some additional repayment time to add forgiveness time to your history, which will shorten the time it takes for you to get to forgiveness, right? So if you have older loans from before vet school, if you have those non-direct loans, health profession student loans, those older FEL program loans, loans for disadvantaged students, this is the time to clean it up. You will probably never, ever get another time to do this, right? So I don't know when it's going to end. They keep extending it, right? I mean, if, depending on what happens in the election this November, if there's a switch in administration, I know it's going to end, right? But if there isn't, then maybe it will continue. Who knows, right? But this is a crazy, crazy, crazy benefit to take advantage of right now and to clean up any mishaps you may have had with your student loans over the years. All right, the save unpaid interest subsidy, just to make sure everybody is clear on that. When your minimum monthly payment is less than the monthly interest accrual, that's when you receive the subsidy, right? So let's say you've got $200,000 of student loan balance, 6%, and you're accruing $1,000 a month of interest, and you have a $0 minimum monthly payment. The Department of Education is covering that $1,000 of interest that your payment is not covering. If you were to pay $500, it's not going to hit the principal, right? The subsidy is provided net of all of the payments you make, which is why it doesn't make any sense to pay more than the minimum, right? I wish that you could pay extra and it would hit the principal and you'd see the balance go down, but that's not how it's set up, right? The law requires that any payments you make must first be applied to interest before they can be applied to principal. So if the Department of Education is covering all of your interest through the subsidy, that first payment that you make up to the amount of interest that's accruing each month will just reduce the subsidy, right? So if you think that I'm going to pay $500 extra because the government's covering all of my interest and it's going to reduce my principal by $500 a month, you're going to find out that you actually ended up wasting that $500 payment, literally lit it on fire, right? So don't pay extra towards your student loans while you're receiving that SAVE unpaid interest subsidy. Okay, so here's just some general guidelines, right? Are you likely to hit forgiveness? If your debt to income ratio is less than 1 as you're starting your training, then no, you're probably not going to hit forgiveness, and you're probably not going to hit public service loan forgiveness either, right? So, but you could still use SAVE to get the unpaid interest subsidy while your income is very low, and then that using SAVE after will accelerate your payoff, and you'll probably pay the balance to zero sooner than you would under a standard 10-year plan. Right, so you can still use SAVE strategically, even if you have a very low debt to income ratio. If your starting debt to income ratio is greater than 2, then it's quite likely that you're going to reach forgiveness. Right, and this is kind of the, again, coming back to the scenario with the surgeon who's earning a ton of money now, he had a greater than 2-to-1 debt to income ratio when he started his training, had a relatively high starting repayment balance. Even though he's earning a significant amount of money now, he's still going to reach forgiveness. Right, so it's just kind of a probability game, right? The sooner you start accelerating your income, the bigger dent you can put in the probability of reaching forgiveness. But since it takes quite a while for most of you to achieve a specialty status, it's quite likely you can still reach forgiveness even with a specialty income, the way that the income-driven plans are structured now. So again, it's, it's going to just take you checking in, reevaluating, and seeing whether or not you're likely to reach forgiveness as to whether or not it's going to make sense for you to switch gears or how you switch gears once you finish your training. So if it were my dog, right, so this is by the income-driven plan profiles, right? If I'm in that first profile, the most flexible of all of them, I'm going to start with SAVE, reevaluate every year, but particularly before I hit 5 years in repayment to see if it makes sense for me to switch, because I can hit forgiveness sooner under the new version of IBR than I can by sticking with SAVE. And then hopefully by that time frame, I will no longer be receiving that unpaid interest subsidy. So I've kind of, exhausted the utility of SAVE anyway, right? So that would be what I would be doing if I was in this income-driven plan profile. Now, there's nothing wrong with sticking with SAVE, but you want to run those numbers when you're getting closer to that 5-year threshold before you lose the opportunity to switch to the new version of IBR, right? But if the numbers indicate that you should stick with SAVE, then stick with SAVE, right, at that time, right? But it's probably too soon to tell for many of you right now because they haven't started counting this 5-year restriction clock until July 1st, right? So even if you're approaching the end of your residency now, SAVE is still going to make a lot of sense if you're in this profile 1. Profile 2, you're eligible for pay as you earn, but you're not eligible for the new version of IBR. This is the pickle, right? This is where, you've got only till July 1st to figure out if you want to use pay or jump ship and go to SAVE. But if you jump ship, you can't get back into pay after July 1st. right? So that's why it's a pickle, right? So it could be tough to figure that out. We can help you there on the student debt message board area. If you submitted your signalment form, we'll walk through that analysis with you if we find that you're in the pickle. If you have general questions about it, we can help you in the student debt message boards to answer that question. Profile 3, if you're eligible for IBR, the old version and save only, this is myself, this is my wife, because we've been out of vet school for a while, we're not eligible for pay as you earn or the new version of IBR. Save is our best option. So there's really not a comparison there. The old version of IBR is obsolete. We do have some blog posts that are out there too. So if you're in the new grad pickle, which is relatively rare, right? So that's more of the career changers, right? At this point. But for those of you that are in repayment already, if you're between 2012 and 2018 grad years, those are the ones that are most likely to be in the pickle, right? So, you can read through that. And if you want some further assistance, you can post on the student debt message board area. All right. I am going to fast forward a little bit. All right, so side effects of income-driven repayment, we've got negative amortization. So that essentially means your payment is less than the monthly interest accrual, right? That's not very common, but it's also allowed in the federal student loan repayment universe. It's only really an issue now for those of you using IBR or pay as you earn, because SAVE will cover that interest. So you're still in a period of negative amortization. You just don't see the effects of it because the Department of Education covers that interest. Capitalization, where your unpaid interest is added to your principal, is only something that happens with an IBR, income-based repayment plan specifically. This is why you don't want to start with income-based repayment, although we still see a not insignificant number of people who choose the IBR plan out of school, which sucks because then the interest that they accrued will get added to their principal when they put their loans into SAVE or some other plan that they should be in while they're doing their training, right? So again, just double check, make sure when you're applying for the plan that you're applying for the most beneficial plan. The acronyms, the names are very similar. They get confusing. It's easy to choose the wrong one, or heaven forbid, you tell your loan servicer to choose a plan for you. That's where you see things like that happen, right? Where you end up in a plan that you shouldn't be in to start, and then there are some negative consequences to get it fixed, like capitalization. Having to recertify your income, you have to stay on top of this stuff. You can't really just set it and forget it with an income-driven plan. It's the price of that flexibility. And then, who knows what the future changes and updates might be. Thankfully, most of them have been more beneficial rather than less. I think it kind of sucks to lose access to pay as you earn, but SAVE is so beneficial that it's not a terrible option to get stuck with, even if you do lose access to pay as you earn. And then there's always the big question, will forgiveness be taxable when you reach it? So we'll just have to kind of keep an eye on that and how Congress decides to approach that. Time-driven plans are no cakewalk either. They have higher monthly payments. If you refinance your loans, like we were talking about with the private loans, they often entice co-signers to reduce their risk, but it increases your risk. There's usually limited relief when it comes to those. Unless you're earning more and more income, it can be hard to satisfy those time-driven repayment strategies. And in general, you're probably going to pay a higher amount as compared to an income-driven plan if you end up in a time-driven plan for more than 10 years. So they're not better than an income-driven plan unless you can execute them quickly, and that requires a lot of disposable resources. Another common misconception, I would say, federal student loans don't compound. While they do capitalize, right, the interest can get added to your principal. There is no continual compounding of interest in the federal student loan system, right? So a lot of people misunderstand that, and they think they need to race to the end of their balance, get it to a zero balance because of to avoid the compound interest. And that's just a fundamental misunderstanding of how the student loans work. These are probably the most common mistakes: consolidation, procrastination, repayment plan hopping, right? It's okay to switch here and there when a new one comes online, or there's this phase out, like you want to make a decision before you lose access to a plan or something, but you generally don't want to be switching back and forth among these plans very often, to avoid any of those capitalization consequences that can happen. Missing your renewals or those forbearance and deferments that get applied, particularly in those academic settings. Paying more than your income requires is generally not recommended and generally not very helpful, particularly while using an income-driven repayment plan. I see occasionally people that are filing their taxes separately, but then they're not using an income-driven plan. And sometimes I don't really understand that. So oftentimes when you're married, it can make sense to file separately from your spouse to get a lower payment using an income-driven plan. But if you're not using an income-driven plan and you're filing separately, that's often a head scratcher. So, making sure all those things are lined up appropriately. Again, it just kind of comes into double checking, doing that physical exam of your student loans and asking questions when they come up. Any other questions as we wind down here?
Yeah, absolutely. Let's see. I'll start off with, I think we had one that was upvoted quite a bit here. Actually, maybe you had answered that one. So someone had asked, if I paid a large sum during my deferment but stayed in deferment, does it mean I wasted money?
Yes, unfortunately it does.
If there's someone with a large sum of money that's in a deferment for any reason, what should they do with that?
Don't pay it towards your student loans. So there's the large sum of money thing comes up a lot with student loans. There is probably 101, if not more, things that you can do with that large sum of money that will result in something more beneficial than paying it towards your student loans. Right? Again, there's really no measurable benefit to paying your loans to zero faster than your income requires, right? And when you run the numbers on these plans, and if you were, it's a classic example, if you were to take that large sum of money and just put it into some kind of interest-bearing account, chances are you'd come out with more money if you did that and paid your loans based on your income until they either hit zero or hit forgiveness than putting that large sum of money towards the student loans. Right? It's a straight up cost benefit analysis. It just doesn't make sense. Right? So especially if this is a one-time large sum of money, like an inheritance or a sign-on bonus or some, you sold a business kind of thing, right? If that's not a regular representation of your income, then it's not going to be reflected in your monthly student loan payment, which means you can take that lump sum of money, do other more productive things with it, and then continue making payments to your student loans using an income-driven plan, and you'll either pay the balance to zero or you'll hit forgiveness. Right? That's one of those things that falls into the contraindicated category, right? Large sum of money paid towards your student loans are contraindicated in nearly every case when we're talking about federal student loans.
I love this follow-up question. Can I get it back?
Not anymore. You could have during the pandemic forbearance period, which was another huge benefit, where people that had been making payments towards their student loans when they didn't have to could request a refund. But you know that's an unfixable mistake at this point, and one of those reasons why, again, check and ask questions before you do things that are generally not fixable.
Along that sort of lines, is it beneficial to pay off your interest before getting into the save plan?
Absolutely not. Absolutely not. That question comes up a lot. And first of all, where's that money coming from, right? I mean, you guys are going into advanced training or doing advanced training, paying your interest on your student loans while you're earning a below average income is another thing that is in the contraindicated category, right? It's a poor use of those funds, right? Use that money to build your emergency fund, start a retirement fund, keep yourself out of debt while you're doing advanced training. Do not pay towards your student loans when you can likely have a payment that's zero, right? And have the Department of Education cover your interest, right? Please, please, please don't pay the little bit of unpaid interest you have off before you start repayment when you're entering an advanced training program that's paying you too little money.
Is there a resource for finding veterinary specific financial advisors for the future? Or is there a specific certification to look for?
I'll start with some specific certifications. So certified financial planner is a good one to start with. So that generally puts them into a fiduciary category, which means they're bound to act in your interest rather than sell you things that they benefit from. There is also a designation called a Certified Student Loan Planner, a CSLP. That can be helpful. They at least are familiar with the federal income-driven repayment plans. So that can be helpful when you're trying to integrate a comprehensive financial plan in with your student loans. There are some veterinary specific ones that are out there that are starting to emerge and be part of the quote good ones categories. I'm reluctant to, throw names out there just yet, but we talk about them sometimes on the student debt message board areas. And also, we try to align those folks geographically with where they live too, in certain cases. So, but I would start first with the CFP, the CSLP. And if you have questions about any specific ones that you're interviewing, feel free to ask those on the message boards too, and we can provide any information that we might know about them.
If our repayment column says that, looking at the My Student Loans tool, says that we're
Yep.
in school, how do we go about requesting to exit that status so that we can enter an income-driven repayment plan?
Yeah, it may just require some time, right? So it depends on how long ago you graduated. I would give it to the end of this month here. Sometimes that's the trigger, is that it just needs to wait until the turn of the month to hit that grace period status. But if it doesn't switch from in school to grace period with the turn of this month, then I would call your financial aid office and ask them, hey, why are my loans still showing that I'm in school when I'm graduated, right? And maybe they can do something to force that to flip into that grace period status so you can get that consolidation loan started. That's a good pick. That's a good pickup. Good pickup though.
Yeah. How do you determine if consolidation will extend your repayment time?
It won't. Yeah, it won't extend your time. That's the benefit of the count adjustment. So there is no extending your repayment time through consolidation anymore. The count adjustment will preserve at least the amount of time that you've already earned, if not add more, depending on your loan history. Right. So that's the whole crux of the count adjustment, is that consolidation will not restart or add additional time to your forgiveness progress, right? It will only either stay the same or add more depending on the history of the loans that you're adding to that consolidation.
I think that actually answers this other one here. Graduation 2023 or earlier, you shouldn't consolidate your direct loans if you've already started repaying your loans. But I think you just did a great job summarizing that.
Yeah, and I think some people would be under that impression because previously consolidation had restarted your forgiveness clock, but that's what the one-time count adjustment provides the exception for, is it says, no, we're suspending that punishment, which it used to be, and we're going to say we're going to give you at least the credit you currently have, if not add more. So, unless you've already fully consolidated your loans, or there's nothing for you to gain by consolidating now, then you really should take a second look to see if consolidation would benefit you before the end of June.
Is it useful to apply for the one-time forgiveness count adjustment for paid off federal loans?
Yeah, you can't, unfortunately. So yeah, once you've paid them the zero, they're not counted any longer in your count adjustment history.
If we have loans from undergrad and now loans from vet school, this person's a 2024 grad. Should we consolidate the vet school loans separate from the undergrad loans versus consolidating them into one single loan?
Consolidate them all together, right? That's exactly, you are exactly the person who would benefit from the one-time count adjustment. And the example that I used that had 3 years of prior repayment time before they started vet school, right? That's exactly who the one-time count adjustment is meant to benefit, right? So you'll get that entire new balance with 3 years of forgiveness time if you consolidate all of those loans together. We do occasionally see these crazy profiles with various consolidations. I consolidated some of these and not some of these and left some of these out. Don't do it. Like it is just it is not helpful, right? You're making things more complicated than they need to be. If you're going to consolidate everything that can possibly be put into that consolidation, and ideally before the end of June, so you get the maximum count adjustment from it.
Yeah, and you know, I've really been doing a lot of learning from Tony here in the last couple of years, but since I've joined the team, and I have to say, I see some of those like partial consolidations here and there, and I really try to think back, like, okay, like what was the benefit to this? And I've yet to come across a benefit from those
It's
partial
not, there isn't.
consolidations.
It comes down to the interest rate. If you look at them, they're almost always people who are trying to leave certain loans out of the consolidation, thinking they didn't want to put a higher interest rate or lower interest rate in with some loan. And again, it's that there's just no benefit to that, right? It may feel like there is, and intuitively that might make some sense, but mathematically it does not. So there is no benefit to trying to creatively consolidate your loans.
I enjoy this one. Who makes money off the interest of federal student loans? The government, the financial intermediate, the loan service provider, the bank?
Yeah, so right now, I mean, the direct loans are it's part of the general fund, right? So the taxpayer gets the benefits from the interest from the student loans, right? So some of that is used to pay the loan servicers for servicing the student loans, but the lion's share of the interest, to the extent that there is an amount left over above and beyond what it costs to administer the entire program, would go to the general fund, the taxpayer, right? So the older school loans, the FEL program loans, there was a lot that went to the intermediaries, the middlemen, if you will, the banks that administered and initiated those loans. And that was one of the reasons why they cut those folks out, just because they were getting really, really expensive.
I'm not sure if I understand this question. I'll read it and see if you better understand than I do. But if you're still here, feel free to provide a little bit more clarity. If we submit 2023 taxes, but currently do we have zero payments this year?
So if you have a 2023 tax return on file, and if that adjusted gross income shows anything less than about $36,000 of income, then your minimum payment using SAVE will be zero for the next 12 months, or for the 12-month period that starts with you applying for SAVE with that income information.
If we have older loans that are in a deferment status because we're in school, we should consolidate while in school or right after graduation?
If you haven't graduated yet, I would wait until you've graduated and then consolidate all the loans together. You can, it can get complicated if you try to consolidate some loans and then add them later. You do have 180 days from the time that you consolidate loans to add other loans to a consolidation, but it's really complicated, and it also assumes that you remember to do that. So I would not, to increase your chance of success, I would wait until all of your loans are eligible to be consolidated and then consolidate them all together in a single consolidation loan. The add loans within 180 days is kind of a salvage procedure if need be, right? But I wouldn't do that unless you absolutely have to. There are some mad scientist reasons for that. So I don't know when you're graduating, but the University of Arizona folks, you guys graduate in August, which is after the June 30th deadline. So there are some reasons for you to maybe get cute with consolidations to try to get your loans into pay as you earn if you really, really, really wanted to try, but that's something that we want to talk about over on the message board. So let's do that there, because otherwise it's just going to blow people's minds, and we're too far into this to do that for whoever's left.
That's actually a great lead into the next question. Can you post a link to the discussion boards? Would you be able to show how to
Sure.
navigate there from? Thank you.
Yep. Let me head back over. So on the Student Debt Center, if you're logged in, I always forget to do this. So if you're logged in using your VIN username and password, you'll know that. We'll know that, right? You'll know that. You'll see your name up here. But you'll also have a link to the Student Debt Message Board area here. So if you click on that, it will take you into VIN, where the Student Debt Message Board areas are. So this is where there's all of these discussions that are going on, all the cases, if you will, where we learn all this information and then we distill it down and kind of, bring it back to you in terms of kind of best practices sort of thing. So, but there's everything in here from, right here, a 1997 grad to 2024 grads, right? So, and everything in between. So you can post anonymously in here. So there's an option when you open a posting window, if you're starting a new discussion in here that's unique to the Student Debt Message Board areas, there's some instructions that pop up, but there's an anonymous checkbox. Becca and I will know who you are, but the rest of the community doesn't. But any of the nice things, the way that we have it kind of set up here is if you're logged in and you've uploaded your student aid data file and you've posted it to the message boards, or you have a Sigelman form posted here, those are all tied together, right? So Becca or I can see your student aid data file. We can look at the details. So it makes it so it's easier for us to answer your questions that you have about your student loan. So if you do all of these things while you're logged into VIN, when you get over to the message boards, we can better answer your questions because all of those things are tied together.
Absolutely. A couple more questions here. If I'm on the SAVE plan, but I am not eligible for the new IBR 2014 plan, should I change to pay before it's phased out? And what exactly happens to the people on pay once that phase out happens?
Yeah, so if you're using pay, you can keep using it after the phase out date. But if you're not in pay on July 1st, then you can't choose it anymore, even if you're eligible for it or were eligible for it. So only the people that are using pay as you earn on July 1st can stay using it, right? So whether or not you should continue using it will depend upon your work with the student loan repayment simulator, right? So if you were, using the student loan repayment simulator, and let's give this person a few years in repayment, and maybe they're starting their residency, and after their residency they're going to earn 175,000, and during their residency they're going to earn 40,000, right? So we can make some educated guesses on what is likely to happen. Like if you were in the pickle here and I'm scanning the loan repayment simulator, I'm looking to see, am I due to reach forgiveness? Which of these numbers are a little bit lower? In this case, they're really about the same, just based on that quick simulation that I ran. The difference here is I hit forgiveness using pay as you earn versus not hitting forgiveness using save, but the cost profile is pretty much identical. In that case, I'm probably not going to worry about pay as you earn. I'm just going to stick with save. But in certain simulations, you may see a pretty dramatic difference here, where this might say, I don't know, 280,000, and this says a 330,000, right? And in that case, that might be enough of difference in a projected cost for you to say, I want to use pay or make sure I'm in pay before that phase out date, so I can potentially hit that lower cost profile in the end, right? So that's how you can start to work your way through the pickle. But if you have some questions about that, submit a student debt and income signalment form, or you can copy and paste the link to the simulations that you run in the student debt message board area, and we can work through those details with you and say, oh, maybe this looks like a good reason for you to get into pay as you earn before the phase out date, or, hey, don't worry about it. You're likely to benefit from save in the long run. So, don't worry about the phase out date.
Yeah, absolutely. Absolutely. Last question I have here is, if I have one Perkins loan throughout vet school, borrowed money each year of vet school, would I benefit from consolidation?
I mean, by itself, it's hard a question to answer, right? I mean, if it's like a insignificant component of your overall balance and there's nothing else for you to gain by consolidating other than adding that tiny remaining balance in there, then maybe don't, right? But at the same time, if you ever were to consolidate your loans, this would be the time to do it.
Yes.
Right. And I do someday, maybe I'll better understand why people are so always looking for a reason to not consolidate their loans. But I mean, yes, the application, if you didn't have to do it, it's better than not. But this is a crazy, crazy beneficial opportunity that if it requires you to consolidate or you can benefit from consolidate, do it, right? Don't look for reasons why you don't have to do it, right? It's kind of weird to me that people seem to always be looking for the reason why they don't have to consolidate rather than the reason why they should consolidate, which is often way more beneficial, right? There are way more instances that I've seen of people missing out on things because they didn't take advantage of the consolidation than I don't know, one or two people through the years that may have somehow in some, backwards fashion benefited by not consolidating, right? So it is strange to me that people do really bend themselves backwards trying to figure out reasons not to consolidate when it's actually very beneficial.
Yeah, I definitely remember, being a vet student and listening to these talks and being like, oh, wait, that consolidation thing sounds scary. Because to me, it was very much an unknown, right? Like, it
Yeah.
wasn't something I was super familiar with. And I do have to say, like, learning more about this, I'm like, it's a tool in your toolbox. Like,
Yeah.
it's a resource that you have to be able to, especially right now, benefit from the one-time forgiveness counting adjustment if that's applicable to you, and things like that, and that grace period early. It's not quite the scary unknown that I originally thought it was.
Yeah, and right now it's a really shiny and powerful tool, right? And
Right.
that period's going to end, and it's still, we briefly experienced that, having to tell a few people that you missed out, right? And it sucks to have to tell people that, right? Don't be one of those people that, we have to tell. Well, you kind of missed the boat on that one.
Yeah, absolutely. Absolutely. Well, thank you so much, Tony. Really appreciate this. Thanks for everybody joining. Again, we'll have the recording, Tony's Prezi, so all the links there, some other helpful information that'll go out via email in the next couple of days. That will come from studentdebt@vinfoundation.org. So make sure to keep an eye out for that. If you miss it, check your spam folder there. And with that, thanks everyone. Really appreciate it.
Yeah, thank you, Becca, and thanks to everybody who joined, and particularly those of you that had kind of made it all the way to the end here. And please feel free to reach out if you have any questions, or you're not still quite sure what to do. That's what we're here for, and that's what we specialize in. So we'll get you the answers that you need, and hopefully on the right track with your student loans.
Thanks all.
Yep, thank you.